It is the evening of January 15th, 2026. The markets have officially closed. The frantic shouting on the exchange floors has quieted down, and the financial news cycles have moved on to the next shiny object. But if you are watching the metals right now, if you're actually looking at the tape, you can feel it. It's that thick, heavy, suffocating air you get right before a massive structural break. I'm a private commodities analyst. I've spent the last 12 years stacking physical silver and trading the equities of the companies that dig it out of the dirt. I built this channel for one reason. I got tired of waiting 6 hours for mainstream outlets to report on moves. I was already seeing in real time on my Bloomberg terminal. And frankly, I'm done with the AI avatar channels that just pump out recycled hype and fake news. I use this avatar for one reason only: speed. I can get the data to you, processed and analyzed, faster than any newsroom. No theatrics, no scripts written by interns, just the raw data. Tonight, I need to walk you through something happening right now, something the financial media won touch with a 10-foot pole because it exposes a mechanism they do not want the retail public to understand. Let's look at the hook. Silver got hammered this morning. At 9:45 a.m. Eastern, we saw a brutal 4% dump in a matter of minutes. This wasn't a natural cooling period. This was a surgical strike. It was a move designed to trigger stop losses, shake out the weak hands, and make retail traders panic sell their positions and swear off metals forever. The mainstream narrative. They're calling it a technical correction for a stretched sector. They want you to believe the silver bull is tired. They want you to rotate your capital back into tech or bonds or whatever the banks are pumping this week. But the screen is lying to you. Because while silver bled 4% at the open, the miners of the actual companies producing the metal barely flinched. The silver miners ETF, ticker SIL, only opened down 1.4%. By midday, it had recovered almost all of it. Let that sink in. Silver down 4%. The miners only down 1.4%. In any rational market, miners are leveraged to the metal. If silver drops 4%, the miners should drop 8% or 10%. But they didn't. They showed massive relative strength. That is the first signal of a major trend reversal. That is the market telling you that the official story is a lie. 5 o'clock to 8 o'clock, the OPEX catalyst, the 12-hour countdown. Why is this happening now? Because tonight, as you watch this, we are less than 12 hours away from January 16th, the third Friday of the month. Monthly options expiration, OPEX. For those of you who've been in these trenches long enough, you know what that means. It is the most dangerous day of the quarter for institutional short sellers. It's the day where billions of dollars in derivative positions either print money or explode in the face of the market makers. The miners aren't moving yet because they are being held underwater by a very specific, very expensive anchor. My thesis is clear. Silver miners are being artificially suppressed to protect massive bank short positions ahead of tomorrow's expiration. I am going to prove this to you with hard math and a mechanism most retail investors don't even know exists: operating leverage. Right now, silver is trading near $91, but mining stocks, the companies producing the metal, are priced as if we were still in a $30 environment. This isn't a lag. It's a structural anomaly. Let me teach you the concept of operating leverage, because it is the key to the catch-up trade. Operating leverage is the magnifying glass of profitability. It's what happens when your sale price explodes, but your costs stay fixed. Imagine you run a lemonade stand. It costs you $1 in lemons and sugar to make a cup. You sell it for $1.10. Your profit is 10 cents. Now imagine a heat wave hits. Suddenly, people are desperate. The price jumps to $10 a cup, but your lemons and sugar, they didn't get 10 times more expensive overnight. Your costs are sticky. So now, your profit isn't 10 cents at $9. That is a 9,000% increase in profit from a 900% increase in price. Now look at the silver miners. These companies have an all-in sustaining cost, AISC, of around $30 per ounce. That includes labor, diesel, machinery, and taxes. When silver was at $35, their profit margin was $5, a 14% margin. They were surviving, not thriving. But at $91 silver, with that same $30 cost, their profit is $61 per ounce. Their profitability didn't just double, it didn't triple, it increased by a factor of 5. And yet, the stock prices are flat. They are spring-loaded. This is the most undervalued sector in the entire macro landscape. Now, let's address the skeptics. Argument 1. Costs are rising too fast. The bears say inflation in diesel and labor is eating the profit. My rebuttal: yes, costs have risen, but they haven't tripled. If a miner's cost went from $30 to $40, that's a 33% increase. But silver went from $35 to $91, a 160% increase. The math is in the quarterly filings. These companies are printing record free cash flow. They are paying down debt and hiking dividends. The inflation argument is a smokescreen. Argument 2. Jurisdictional risk. Governments will tax it all away. My rebuttal: this fear is exactly why the stocks are cheap. It's already priced in, but governments are slow. Bureaucracies take years to draft windfall taxes. By the time the legislation is signed, the stock could have already moved 300%. We're looking for the violent catch-up rally, not a 20-year dividend hold. Look at the short volume in Hecla Mining HL. It's at record highs. That isn't smart money hedging. That is a desperate attempt to keep the lid on a pressure cooker before it blows. Tomorrow is the day the paper market meets physical reality. There are massive open interest positions at the $90 and $95 strike prices. Billions are on the line. If silver holds $90 through the close tomorrow, the banks are in serious pain. Here is my personal dashboard for tomorrow. The silver to SIL ratio. If the miners move faster than the metal, the decoupling has begun. The DXY. If the dollar index shows weakness, it's rocket fuel for this move. The $90 level. If we hold $90 through the morning session, the suppression has officially failed. My trigger for adding to my positions. If the miners SIL finish today flat or green while silver stays in the red, I'm buying more. That is a classic setup for a sector rotation. However, I use risk management. If silver drops below $85 tomorrow during the OPEC's chaos, I will not catch a falling knife. I will wait for Monday's tape. Options expiration days are designed to inflict maximum pain. The market makers know where your stops are. They will try to pin the price to the level that causes the most contracts to expire worthless. Don't fight the tape if it's telling you you're wrong. In 2025, silver rose 140%. It was one of the best performing assets in the world. Yet the miners are only just waking up. During the 2010-2011 bull run, we saw this exact pattern. Silver went parabolic, the miners lagged, and then out of nowhere the miners exploded. Some juniors went up 1,000% in weeks. We are in the media blackout phase. CNBC isn't talking about silver miner cash flows. They are talking about AI and crypto. That's exactly where I want to be. I want to be positioned early while the consensus is that metals are a boomer trade. To recap, silver is at $91, but miners are stuck in a $30 mindset. This disconnect is being forced by the OPEC's deadline tomorrow, January 16th. The operating leverage makes this an asymmetric bet. The numbers don't lie, but the prices do. Tomorrow is the test. Tomorrow is the pressure release valve. I've been in this game for 12 years. I've been right and I've been wrong, but I've never seen a valuation gap this wide. Stay sharp, stay disciplined. Don't let the noise distract you from the math. The opportunity is right in front of you. Now, we just have to see if the market agrees. Stay frosty. I'll see you at the opening bell.